President Trump bashes Fed Chair Jay Powell again and doubles down on tariffs as he marks 100 days in office. Another day of big bank beats. UBS, Santander and Barclays all smash estimates. But tariffs upend autos as Mercedes and Stellantis withdraw guidance, while Volkswagen sees a 40% earnings plunge. So there's a lot to get through. Let's go straight to cross assets. Look, the one thing that we look at is, of course, treasuries, equities every day. We're in the full of earnings season. So, again, they give us an indication on what kind of pricing we could see going forward. A lot of focus also on tech starting this evening. Now, European stocks are pretty much rising. U.S. futures, though, slipping. So you see a bit of a divergence. S&P futures down 0.2%. Again, tariff turmoil throwing up a little bit of a mixed impact on company earnings. So it does really depend on the sector that you follow and that you look at. And then investors looking ahead to some of the key U.S. economic data Thursday and Friday. A lot of the tariff turmoil may not be fully in the numbers yet. Euro dollar 113.72 and then Brent at 63.30. Again, let's quickly get onto European markets map because there does seem to be a little bit more buoyancy in European markets, although some of the concerns may be around some of the tech, some of the chip makers. But again, if you're in Spain right now, so you're seeing a loss of 1.1% on the IBEX, the CAC 40 gaining some 0.3%. Also, a lot of data here in Europe. We had France a little bit earlier. Germany GDP actually rising as much as expected. Italy also a little bit better than expected. Look, just take these with a pinch of salt because, again, you don't have the tariff turmoil that has already impacted these numbers. And then, Germany's CPI actually rising 1% year on year. Again, we look at growth and we look at inflation to find out what central banks can do. So for this conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, U.S. President Donald Trump has marked 100 days of his second term by touting his economic policies and again criticizing the Fed Chair Jay Powell.
And inflation is basically down, and interest rates came down despite the fact that I have a Fed person who's not really doing a good job, but I won't say that. I want to be very nice. I want to be very nice and respectful to the Fed. You're not supposed to criticize the Fed. You're supposed to let him do his own thing. But I know much more than he does about interest rates, believe me.
President Donald Trump spoke at a rally in Michigan, America's car-making center, just after signing orders to ease some auto tariffs. Now, we'll get onto the markets and equities in a second, but first, let's bring in Ross Matheson, our EMEA news director. Ross, thank you for joining us. I mean, there's a lot, because actually he again doubled down on Jay Powell, saying, I can't criticize the Fed. And so this was like a flamboyant, pretty confident Donald Trump.
Well, it was, but it was also a recognition in a way that we are seeing some concerns bubble up amongst American companies, but also ordinary Americans, American voters. We can see that in sentiment surveys showing concern about where the economy is going, about job security, about inflation, about, again, the impact of all this whipsawing on U.S. policy under Donald Trump. What does it mean for people inside America? So talking very much to his audience there, very traditional Donald Trump-style rally that we've seen, touching on a bunch of things, inflation, growth, obviously, again, the Fed. But the Fed was all part of that narrative, which is whatever you've heard about the last 100 days and the kind of policy making that's gone on. The economy is looking good, and I'm going to take care of you. So very much a message directed at the American people.
And Ross, he was also unapologetic on the tariffs, and the White House also went after Amazon for, a rumor that they were going to publish how much the tariff cost each item.
Well, that's right. There's a bit of he said, she said in that. Was Amazon actually ever intending to do this? They say no. Did it take a call from Trump, an angry call to get them to back down? That's unclear. But what it does show again is that these companies under this de minimis rule, obviously with these companies that ship a lot of smaller parcels to the US, we see this with Shein, with Temu, they are being impacted by all of this, and Amazon is getting caught up in that in some fashion. And you can obviously a great sensitivity again from Donald Trump on that. So he reacted quite quickly to that report yesterday, even though it was again denied. But more broadly, it points to the complexities these companies are facing, navigating policy that's changing often by the minute, even in terms of how they operate. And you've got to change all your business structure, supply lines, paperwork to be compliant. That's a big challenge, even for a company like Amazon.
Ross, thank you so much, as ever, for all of the insight. Our EMEA News Director, Ross Matheson. Now, U.S. futures point to a pause, six-day rally. Markets await tech earnings. It's certainly been a dizzying few months for stocks. The chief executive of Goldman Sachs told us exclusively that he thinks markets will, quote, settle down soon from the tariff chaos.
If the level of uncertainty grows from here, yes, you won't see the same amount of capital markets activity. But my own belief is things will settle down. We'll have a clearer policy perspective and some normalization of capital markets as we shift into 25 and 26. Even if we have a slower economy, or even far worse, we have a recession, ultimately, when the market adjusts to that and resets, people need to transact. They need to raise capital. They need liquidity for their investments. And so part of this is just a reset of expectations.
So that was the chief executive of Goldman Sachs, who we spoke to yesterday. Now we're joined by Christopher Wood. He's global head of equity strategy at Jefferies. Christopher, thank you so much for joining us. Now, you put a note out, which I have to say one of the most top-read stories that we had last week, basically saying that you think the best is over for U.S. stocks.
No, friends, I've been stating since the start of the year that my base case, until proven wrong, is that U.S. equities reached an all-time peak of MSCI or Country World Index on the Christmas Eve last year. So I think it's an all-time peak in U.S. dollar terms, just like Japan made an all-time peak as a percentage of world stock market capitalization at the end of 1989. But obviously, I'm assuming part of that is a weakening dollar.
Right, but so is this on tariffs and some of the turmoil that we've seen, or this is just more of a structural effect of the way the indices work?
No, this is a structural thing because, frankly, the U.S. reached, I think, 67% of world market capitalization. This is extreme. Even if the U.S. economy is doing well, 50% would be a high weighting. And we had all this talk of American exceptionalism in the fourth quarter of last year, which was a sign of a massive top. We had S&P trading at an all-time peak of price to sales. The tariff noise is just an additional negative. So if Donald Trump really does go ahead with the tariffs, then clearly you should sell all these stocks today now. Now, there's still a chance that he backs off. But, the simple point is that tariffs are very bad news for everybody.
Yeah, and I guess this just adds a layer of complexity, right, to try and understand where it goes. I mean, is U.S. exceptionalism now over?
No, I never believed in U.S. exceptionalism in a financial sense. There's one area the U.S. isn't completely exceptional in financial matters. That is the ability to print the reserve currency of the world. That is the true source of American exceptionalism in financial issues. But the irony is that the Donald Trump agenda actually threatens that huge privilege of the U.S., which is indeed to print the reserve currency of the world.
Yeah. But Chris, why are markets not really seeing what you're telling us? So there has been a correction, but actually, if you look, they've been pretty much flat since January.
No, we've had a big relief rally, and it's partly encouraged by growing hopes that Donald Trump's going to do a U-turn on the tariffs. Right. Which he's already done. He's already done significant U-turns. So clearly, if he announces today no tariffs, the markets can rally further. But it won't just be the U.S. rallying. China will rally and other markets will rally.
Right. But do you think even if tariffs are taken off or they're tempered somewhat, that actually there's permanent damage done to, what people see as the havens of the U.S.?
Yeah, because actually there's real catalyst to buy, Mark. This year there's a much better catalyst to buy Europe than there is the US because Europe's much cheaper. And we've had a very distinct positive catalyst, which is the German fiscal revolution, the revision of the debt brake, and Germany is going to kick in with fiscal expansion. So there's a catalyst in Europe you don't have in the US. The question in the US is, do you avoid this negative catalyst of higher tariffs?
Yeah, so we did a chart, Chris, we're basically trying to encompass some of the earnings because we're in full earnings season, so they're coming left, right, and center. And we basically put them in three categories. The ones that, the U.S. companies that could be okay under the tariffs, the ones that really struggle, and the ones that haven't really said anything, so they can't quantify it. So we put, for example, UPS, Pfizer, and P&G in there. Do you look at sector to choose, or is it just regional?
Well, no, there's another issue. Let's say say we suddenly hear there's going to be no tariffs, that'll be very bullish. But we still have then the issue of the massive amount of capex being spent on big techs, on the AI story. So personally, my view is that they're overspending on this AI story. Yeah. I think DeepSeek was a huge moment. And the message of DeepSeek is that so-called large language models are going to become commodities. So even if you take out the tariff story, I think there's an issue for big tech. And the market will probably start to refocus on that when we get this earnings season.
Okay, Chris, do you sell off some U.S. stocks at the moment to buy, for example, European stock, Japanese stock, and UK stocks?
No, yeah, but I would be adding to China, Japan, Europe, and in India. That's where global investors should be diversifying away from the U.S.
I mean, it's easier maybe for India to find new trade routes than Europe if they have to choose between China and the U.S.
No, India won't want to play both sides. There's no reason for India to make an enemy of either. But right now, Donald Trump needs to do some tariff deals outside of China. So that creates an opportunity for countries like Japan and India to negotiate a better deal with the U.S. than if there wasn't this pressure on the Trump administration.
As head of global equities, I'm sure you look at the Treasury market as well, because are Treasuries still a haven in the U.S.? And if not, how are they behaving?
No, I've been bearish on Treasuries since March 2020 when the Fed printed all that money because of the pandemic. So my view is that Treasury bonds have entered a long-term bear market, all G7 government bonds, and I've preferred since then local currency emerging market government bonds. I'd rather own long-term U.S. corporate bonds than the Treasury bonds because U.S. corporates have far superior balance sheets to the U.S. federal government.
And how much should we worry about private credit?
And if there's a real U.S. downturn, what blows up in America is private equity, private credit. But we need a real downturn. Without that downturn, you won't get the blow-up. So that's the question of whether we have a U.S. recession. And I've got no strong opinion on that. But if we really have the tariff agenda implemented as stated, then clearly the risk of a U.S. recession rises. And tariffs are a regressive tax hike on ordinary Americans.
Okay, so interesting. Chris, don't be a stranger. You have to come back for more market analysis. Thank you for joining us, Christopher Wood, their Global Head of Equity Strategy at Jefferies. Now, coming up, we'll explore how President Trump's return to the White House has reshaped U.S.-China relations. That's next, and this is Bloomberg.
So far, we haven't really seen a major shift in asset allocation by clients. And when you look at the first quarter and the first couple of weeks in April, they took more advantage of market volatility to reposition their exposures within the already set asset allocation. When you look at the last couple of weeks, it's fair to say that probably there is a little bit of fatigue coming in from news, coming from the trade tariffs situation. So, for the time being, I have to say that despite the real or significant spike in volatility and huge volumes, we saw peaks in volume that exceeded 30% of the COVID times in the first week of in the first couple of weeks of the second quarter. So, despite all of this, clients are quite calm and focus on managing within their asset allocation.
Is that volatility, that peak in volatility behind us now, do you think?
I don't think so. I think that's, as I said, probably now there is a little bit of settling down. I think markets have found probably a new dimension in terms of where to reconsider things from, and now it's going to be depending on the developments on the tariff front. I think that uncertainty is there. It's very positive to see that there are ongoing discussions in terms of finding agreements. Having said that, if this goes on for too long, uncertainty has also a cost, and therefore probably investors and corporates will slow down their investment plans.
Well, that was Sergio Ermotti, Chief Executive of UBS, speaking to Bloomberg's Tom McKenzie. UBS's market unit posted a record performance as geopolitical turmoil spurs volatility that the bank says is set to continue. Now, net income for the 3 months, actually, to March, came in at around $1.7 billion, beating estimates. So let's get straight to Tom, who did that great interview in Zurich. Tom, thank you for joining us. Look, it's very clear that they benefited from volatility. What else did Sergio Ermotti say?
They certainly did benefit from that volatility, and as you say, the capital markets then division, the markets unit coming through with the best quarter that it's seen on record. But to your point, Sergio Ermotti telling me that he doesn't think volatility has peaked. He thinks there will be more spikes in volatility going forward. They saw that benefit in terms of volumes at period during the quarter, the most recent quarter, at levels that we've not seen since COVID, again, according to the CEO. So yes, the trading of equities, fixed income and FX really bolstering the results. And across the metrics, top line, a beat, of course, for UBS. They're hitting the metrics on what they can control. The risks, of course, going forward, volatility, it's two-sided. As a result of that volatility, Sergio Ermotti telling me you could see corporates pulling back their investment plans, for example. He's already seeing a sense of tariff fatigue amongst some of their clients. He's not seeing a big switch up in terms of asset allocation from their clients. Some have been taking advantage of that volatility, but he was pretty clear in terms of pointing out the downside of that uncertainty. Just as the trading unit performs very well, the downside risks, of course, in terms of corporate investment if the tariff uncertainty continues, and on a broader, more macro level as well, if you get to a lower rate environment, what that means for net interest income that has already softened and UBS projects will soften further through the year.
Tom, what did he say about future capital levels that I know the Swiss bank or the Swiss regulators are looking at?
Yeah, look, this is a question you've put to him in the past, of course, because it is the key uncertainty along with the tariff uncertainty, the unknowns around what the capital requirements are. This so-called too big to fail plan that the government and regulators and the Swiss National Bank are putting together. Sergio Ermotti saying we could get the first details of that proposal as soon as June. They do not know what it's going to look like, but we know that leading up to this, there's potential requirement to see an increase, potentially an increase of $25 billion in terms of their capital requirements. UBS has made the case, has long made the case, that would make them uncompetitive versus their US, even some of their other European counterparts as well. It could put into question as well the return in terms of the buybacks of cash to shareholders. They have bought back about $500 million worth of shares so far. They plan a total $3 billion by the end of this year, but with the caveat around what happens in terms of those capital requirements from regulators here in Switzerland. Again, we may get more details, according to the CEO, at some point in June. In terms of the integration, seems to be going quite well. JP Morgan analysts coming out and saying, as far as they're concerned, in the last 30 years, this is one of the smoothest integrations they've seen within the banking space. But this is key in the next 12 months. They're going to be migrating a lot of their clients, about 1 million clients in Switzerland, onto a single platform. Potentially a tricky period going forward. And executives have suggested that this is going to be crucial in the 12 months ahead. But so far, integration is progressing smoothly.
Great interview. Our Tom McKenzie there in Zurich with the UBS Chief Executive Officer Sergio Ermotti. Now, U.S. tensions with China show no sign of slowing down. Instead, the tariff trade war continues, with President Trump saying yesterday that China deserves the steep tariffs he has imposed on the country. China, meanwhile, is racing to make allies with countries across Asia and South America as global alliances are redrawn. Well, joining us now is Alicia Garcia-Herrero, Chief APAC Economist at Natixis. Alicia, thank you so much for being with us this morning. When you look at the massive trade war between China and, of course, the U.S., I mean, China seems to have a lot more going for it than maybe we initially thought, including allies in the region that won't walk away.
Absolutely, because China has been preparing much more than Trump has, no matter what his initial measures seem to imply. China knew Trump was coming much more than we Europeans thought he was coming. China has prepared both in terms of fencing off tariffs by basically domestic production, but also signing trade deals such as the RCEP with the rest of Asia. And all of this has been happening since Trump 1.0 and during the Biden administration. China has also been moving up the ladder in terms of less dependence from critical technologies from the U.S. And it has also built a fortress, whether it's gold or other currencies, to fend off also the potential de-dollarization that Trump could have brought about, which we have started to see. So Trump surely is less ready than the Chinese leadership is. However, that doesn't mean China will not suffer. It's only a question of resilience suffering. China will suffer in terms of employment and many other variables that are important to note.
Alicia, when you look at how China has been reacting, right, to the trade war, it's a lot more domestic support. But again, what can we expect next for them to try and somehow protect their economy whilst at the same time hurting the U.S., if that's what they want to do?
Yeah, that's what they want to do. It's not only about protecting their economy. You are so right. They also want to hurt the U.S. And this is a double strategy. So to protect their economy, they will do a little bit of fiscal, not too much. They don't have too much room. China's fiscal deficit hovers around 10% of GDP. And that is why we won't see major announcements. They did it before. Remember, September 2024, they started with that, in a way, in preparation for Trump. But that's all they can do. On the monetary side, they cannot cut rates too much because the RMB could be very weak, and that would bring capital out of China from Chinese themselves. And they can't afford that. It's already bad enough that many U.S. asset managers will probably have to retrench away from China. So there's many things they cannot do. We can't forget that. But they have their people's support. That's the most important. From probably blaming the party, even maybe in without too much notice during the zero COVID times. Now every blame goes to Trump, and that is extremely important for China to support to basically have everybody on the boat to withstand Trump's pressure.
I mean, will Chinese firms continue to reroute through Southeast Asia? And again, how does that change the complex actually globally?
Yeah, great question. So there's two scenarios. Trump comes in, I don't know how many days he has left, 70 days, with more tariffs on Southeast Asia, because these countries just can't accept Trump's conditions, which is impose huge tariffs on Chinese imports because they depend so much on Chinese imports. This is the case of Vietnam, Cambodia, Malaysia, countries that Xi Jinping did visit and reminded them, you depend on me, my dear, so you can't really take Trump's deal. So some are already doomed for basically decoupling from the U.S. And the U.S. will probably impose tariffs because they can't get much out of these countries. And I would insist, Vietnam is one of them. Vietnam is very important because a lot of that bypassing of tariffs was going through Vietnam. So China will have to find others, maybe Thailand, maybe those that are less in that very wall that Vietnam is, because Vietnam depends so much on China. And they will find others. And the U.S. may have by then accepted no tariffs for those other countries. So, China will move on, and it will be very hard for the U.S. to stop it.
So, Alicia, I mean, what does it mean if there is real decoupling? And we've been talking about it for a long time, but frankly, it's not really happened between the U.S. and China. What sectors will be hardest hit? Is it tech? Is it financial? Is it retail?
Well, retail will be the first to be hit if these tariffs are maintained. But I think, frankly, by now, I mean, we had Trump rallying for the 100-day, benchmark. I wouldn't call it landmark. Yeah. Didn't go very well, benchmark. But we also saw him actually lifting tariffs on autos. You see, he's playing a double game. There you go. He's dancing, but he's lowering tariffs at the same time. So that's quite interesting. So in other words, retail will suffer, but Trump realizes that. So he will lower those tariffs. I'm 100% sure. He knows that inflation will kill him in the midterm elections. So I think tech might suffer more, financial services may suffer more because the impact on people, direct impact on households is less evident. So I would go for retail less and tech and finance more.
Alicia, thank you so much for all of the insight. I do like the dancing as well. We should perhaps one day do a rendition. Alicia Garcia-Herrero, the chief economist there for Asia Pacific at Natixis. Coming up, as Alicia was saying, President Trump marks 100 days in office. So we'll look at how the main promises from his campaign are actually holding up. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump bashes the Fed Chair Jay Powell again and doubles down on tariffs as he marks 100 days in office. Another day of big bank beats. UBS, Santander, and Barclays all smash estimates. But tariffs upend autos as Mercedes and Stellantis withdraw guidance, while Volkswagen sees a 40% earnings plunge. Now, Amazon has rejected reports that the company was planning to display the cost of tariffs on products on its website, saying it was never under consideration. Now, this comes after the White House press secretary, Caroline Leavitt, called the reports a, quote, hostile act. I'm joined by Bloomberg's Peter Elstrom, who's in charge of all tech reporting for us. Peter, thank you for joining us. This feels like a very big story. Just the fact that the White House went very aggressive in calling this hostile. What does it tell us about the relationship between between Amazon and the White House?
It was a very dramatic burst of news here. As you mentioned, there was this report that Amazon was considering breaking out what the tariffs were going to cost consumers on its website as it sold goods. And you can imagine why that would be so dramatic. If you're talking about buying a microwave for $100 and then you see that maybe it would be $100 originally, but if you slap on the tariff fee on top of that, it's going to be another $150 on top of it. That's a huge charge. And now, in one sense, this is not that surprising. Hotels and airlines break out these charges all the time. They tell you how much taxes are going to be, whether it's state taxes or local taxes. But as you mentioned, the press secretary came out and they said this is a hostile act. It's a political act. Essentially, it's pointing the finger at the Trump administration, and it would be disclosing for consumers that even though the Trump administration is saying, hey, you're not going to bear the burden of these costs of tariffs. In fact, they are going to pay these kinds of fees. It would kind of expose it to the world. So Amazon very quickly made clear they're not going to do this. It sounds like they had been thinking about it for one section of their site, Amazon Hall, which is their low-end site. But in the end, they decided they're not going to do it at all. They said they'd never really consider it, and it was not going to be implemented.
Peter, Temu and Shein also passing tariff costs on to U.S. customers. So what will be the impact of that?
Right. There's this change in how they tax these sorts of imports. There used to be this de minimis rule where if shipments were below $800, below a certain amount, there would be no taxes or tariffs on top of those. Now, because they are going to get hit with those, they're saying prices are going to go up, and the price increases are quite dramatic at this point. You're seeing 25, 50, 100% boost in some of the costs. Now, Shein and Temu were selling quite low-end goods, so those tariffs themselves are not that high. But if you're a cost-sensitive consumer, this is a big deal for you.
And Peter, what can we expect from tech earnings? Again, they kind of give us an indication of what the U.S. economy will do.
Right. Well, it's a very busy week. We have some of the biggest companies in tech in particular, and it'll be a big lineup. You've got Apple, Amazon in particular. In terms of Apple itself, the company is not growing the way that it used to. You've got slow revenue growth, about 4% as expected by analysts, operating earnings going up just a little bit. But what investors really want to know at this point is how is Amazon going to navigate the tariff and the trade war between the U.S. and China? It's the company that perhaps has most at stake. It makes virtually all of its phones in China at this point, sells them in the United States. It's its biggest, most important market. And we know that Apple has been trying to shift some of that production out of China into India at this point. They're trying to get to the point where they can make essentially all of the phones bound for the U.S. market out of India and then ship them into the United States. Tim Cook is really the mastermind of this supply chain. He built it when he was working for Steve Jobs. Now he has to talk about how he's going to change that approach. In terms of Meta, there are a lot of questions about how the company is going to do in AI. Microsoft. With Microsoft in particular, it had this close alliance with OpenAI. They worked on AI projects together. That has cooled a little bit at this point. We've seen that Microsoft is pulling back on some of its data center expansion, some of its investments. Investors are going to ask questions about how exactly that's going at this point, how that's going to affect its long-term prospects, and whether it still sees the kind of big opportunities in AI that investors are hoping for.
Peter, thank you so much. Peter Elstrom, as always, Bloomberg's executive editor for global technology. A nice roundup, putting tech, of course, and tariffs together. Now, Donald Trump made a barrage of promises for the first 100 days in office, from slashing the federal government to ending the war in Ukraine. Now, let's discuss his achievements and failures so far with Tina Fordham, founder of Fordham Global Foresight, and Leslie Vinjamuri, director of the U.S. and the Americas program at Chatham House. So thank you both for joining us. Leslie, I mean, there's quite a lot of turmoil in the market. There's a lot of confusion over policies. There's some things that actually he said he would do, and that's on the cards. But where are we 100 days in? It feels a lot longer than 100 days.
It does feel a lot longer than 100 days. He's moved fast and furious, but if you actually look at the achievements, he has certainly delivered on the border, and that's been absolutely critical to many Americans, not only his base. Stopping that immigration, it has really ground to a halt. He hasn't gotten the deportations that he wanted, but he's really cracked down on immigration, and I think Americans appreciate that. But when it comes to, the big flagship, delivering the geopolitical deals, delivering peace in the Middle East, delivering peace in Ukraine and Russia, he just hasn't done it. Yeah. And there's really very little sign of progress on these fronts.
And, we always, thought that he would look at the markets, but then he looks at the markets, comes down, but even yesterday he couldn't really help himself but go after Jay Powell. How concerning is this?
Markets are very concerned, and while it's too soon to say that Wall Street has abandoned its support for President Trump, it certainly has a significant degree of buyer's remorse, and we see that reflected in companies delaying their earnings. We see it, of course, in U.S. Treasuries, consumer sentiment on the decline. President Trump hasn't delivered what market participants were expecting, which is massive tax cuts, lots of deregulation, and really particularly equities-friendly kind of changes.
Yeah, and this, it's unlikely. Again, there's a lot of questions on whether, even if he walks down the tariffs, the U.S. has been permanently damaged in terms of policy credibility.
And here's where I think there's a big disconnect between U.S. market participants and Americans and the people we're talking to in EMEA, in Asia, et cetera, where there is this sense that the United States under President Trump has really abandoned the post-war settlement formally. This was in progress for some time. President Obama was famously ambivalent about the use of U.S. military power. So it's not new, but a line has been drawn. The U.S. is not participating in the post-war security order that it built or the trading system, and that leaves a big power vacuum.
Yeah, and Leslie, at the same time, when you look at Europe, how much leverage does Europe have at this time, given its large role in world trade at a time when, Trump is tussling with China? It's a new world order that we're looking at. Can Europe actually come together and prove itself as a player?
Well, I think there is extraordinary energy in Europe. I've been deeply impressed by the conversations that I've been sitting in the UK, across London, across Europe. Donald Trump has succeeded in delivering his message that America simply will not come to the defense of Europe in the way that it has for nearly 8 decades, either on the security side or on the, stability and predictability on trade side. He has upended the liberal international order, and especially 2 key parts: America's commitments to its key allies, especially in Europe, and America's commitment to the rule of law and democracy at home. He's pushing that as far as he possibly can. Europe is very actively seeking to do more. It's seeking to invest more, to spend more. We've seen what's happened in Germany, making it possible to invest more in its defense industrial base. We've seen cooperative efforts coming out of Europe. It's really quite remarkable. But as you've indicated, it takes a lot of time at a time when we know that Europe is well aware of the challenges it faces domestically on growth. Where is it going to get that money to spend on defense, even though the benefits are, in terms of creating jobs and creating some sort of alternative engine for growth in the medium term are good. In the short term, it's very difficult. And I think the fact that war in Ukraine, the prospects for a peace deal do not look any closer than they did, when Donald Trump inherited the presidency in January 2020. He said 24 days. If anything, he's emboldened Vladimir Putin. He's not really used America's coercive power to threaten Putin in ways that would bring him more effectively into a peace deal that would deliver a ceasefire that Europe could then help to try and sustain. But it's a very difficult situation for Europe.
It is a very difficult situation. And then in just 3 weeks, we also have the G7 finance ministers meeting in Canada. I mean, is the G7 now defunct as a real organization?
This is what I find fascinating about the elections that we just had in Canada. In 25 years of covering political risk, Canadian elections have barely kind of made a little ripple in terms of market participants' interest or global interest. Canada, a very safe ally. Now Canada has bucked the anti-incumbent trend. Liberals in power for 4 terms. Mark Carney, the consummate globalist, he said he was going to govern in econometrics, which, warmed my policy analyst heart, as opposed to campaigning in poetry and governing in prose. He said he campaigned in prose, he was governing in econometrics. And Canada will host. And this is after the unprecedented attacks by the White House on Trump. So will the U.S. sign up to a communique? Probably not. But is the rest of the world moving on and creating new coalitions and new power dynamics? That's what I think is really important.
But is there a risk that the U.S. really tries to, make sure that the G7 is hitting China hard?
They can certainly try, but I think that the time at the national level for trying to placate this U.S. administration has passed. And that the U.S. will face a lot more opposition in this usually friendly grouping, the G7.
And Lizzie, as you're saying, there's just a lot, right? There's the executive orders, there's peace in Ukraine, there's the Middle East, there's everything that happened yesterday with Amazon, which, they were maybe thinking of or maybe not thinking. If you draw down on kind of like domestic policy and some of the things that, they're doing with immigration, that's, with law firms and foreign policy, on what front have they been more aggressive on?
I think that Americans would say that what's happening at home, whether it's the drawdown on the executive branch, taking agencies out, like obviously USAID, but others, whether it's pushing the boundaries of executive authority as far as the president can do, really centralizing control over foreign policy in the White House, whether it's on the questions of the economy and immigration. But I think for those people sitting abroad, when you talk about the G7, it's just not clear that that's going to be. There's been a change for a long time, right? Wealth is redistributing and growth is redistributing well beyond the G7. So I think this is kind of accelerating a change where Europe understands it's going to have to not only look to itself, but look to other emerging and middle powers to really develop strong relationships. The big question, I think, right now is what does Europe do when it comes to China? Is this a moment where America's assertiveness, where it's disruption, where Trump's, not taking Europe seriously on any dimension, whether it's with his words or actually with, tariffs and all the other policies, whether Europe uses this moment to form a strategic partnership with China, whether it makes very quick moves to perhaps lessen its caution when it comes to engaging with China, whether it hangs together. I think there's a real concern that this is an opportunity for China not only to lead with its own values and norms and trade practices, but also to divide Europe. And I think, the goal for Europe and for the UK, and that's a dilemma right there, right? The UK and Europe, is to try and hang together when China has every incentive to pull Europeans apart. And Donald Trump would like to do the same. I think Europe is in the tightest spot possible when it comes to this second Trump presidency.
It feels, that China is maybe stronger, right, than we thought it was initially, and also has more allies.
China has a huge opportunity right now, a lot of obstacles to overcome, but slightly, dampening Leslie's enthusiasm for what Europe can do, which I agree with, because Europe has a huge opportunity as well. The conversations that I've been part of are still talking about incrementalism and, finding opportunities. Listen, this paradigm shift that we are experiencing, the parameters of it are going to be determined by two things, in my view. Hard power, meaning who takes advantage of this power vacuum and how do they do it, and markets as a forcing mechanism. So the optionality and the period of optionality is limited.
Tina, I also wanted to ask you, the question is whether this is China's moment, but I wanted to ask you about corporates in America, because I know you also advise a lot of the chief executives. If you're Amazon today, and again, it's unclear whether they were going to publish, how much the tariff costs on top of whatever they were selling, but do you fall in line with Trump policies because you're too afraid to speak up?
I've written about this, and I've said, kind of slightly flippantly about the period of sucking up to Donald Trump and the placate and accommodate period. What the Amazon news yesterday showed was that even Jeff Bezos sitting behind the president at the inauguration, the companies that made huge donations expecting perhaps some kind of grace in return, that isn't going to materialize. You're going to have to toe that line forever. And so the conversation in boardrooms, and I am in these conversations because these are my clients, is very much how far do we take this, and at what point do we start to stand up for ourselves?
Yeah, and this is the million-dollar question, but could it change corporate America for a very long time to come, Leslie?
It is a real risk, but the one thing I would say, and remember, this is a problem for universities, this is a problem for many very powerful actors in the United States. Do they placate to keep those government funds or the policies that would give them preference, or do they unite and push back? And the uniting and pushing back has been very, very slow. On the corporates, Donald Trump cares about the economy. He is not going to like the fact that America's projected growth rates have been cut by the IMF. He can see that inflation is not coming down. The rate of inflation is not coming down fast enough, and he's going to feel it. This is why, in my view, he likely went to Michigan at the 100-day mark. He hasn't been leading rallies, but he, I think, recognizes he is the most unpopular president, just measured by his approval ratings, of any modern presidency at the 100-day mark. He's not. His policies are not being received well. So whether it's corporate America, whether it's universities or law firms, everybody is very slowly weighing up, quite frankly, because a lot of people are scared not only about the financial costs, they're also concerned about personal attacks. They're concerned about how it will impact themselves and their communities. Congress, we're seeing the same thing. Many people within the Republican Party don't support the array of policies. Same, obviously, amongst the Democrats. But the kind of standing up and articulating that and calling for a different set of policies has been very slow to materialize. I expect we're going to see a very different kind of domestic politics on all these fronts in the second 100 days.
Okay, so interesting. Thank you both for joining us. Tito Fordham from Fordham Global Foresight, and Leslie Vinjamuri from Chatham House, soon to be in Chicago, but we'll get you back on to talk about that. Coming up, some of Europe's biggest car makers have scrapped financial guidance for the year, citing tariff turmoil. We'll have the latest next. This is Bloomberg.
Are signs that that investments might start getting delayed if this continues for too long.
We see tariffs are changing pretty often, leading to uncertainty.
We are seeing impact now in terms of incoming container traffic into the U.S. and so on. So it starts to have some real real economic effects.
We believe that tariffs are not the best way to manage this, to manage pharmaceuticals.
Everybody is discussing the impact that tariffs might have.
Obviously, it's hard to predict what will happen in the next 90 days. What we are not seeing yet is that they are actually delaying projects or even cutting projects.
We don't see any hard evidence of that playing through at this point in time. But again, we know those things can change in a heartbeat, so it's on the risk register.
Are you expecting the tariffs to come back down? Again, you don't know whether a tariff is put in place now.
I don't know. I think there is one guy who knows, and it's not me.
There you go, chief executives in Europe and the Middle East on the impact of President Trump's tariffs. Now, uncertainty surrounding the ongoing trade war is emerging as a dominant theme as firms continue to report first quarter earnings on both sides of the Atlantic. Well, Charlie Wells is here with an update. Hi, Charlie. So how are tariffs affecting company guidance?
Francine, so it's breaking down into three categories: hard hit, can't quantify, and manageable. And if we look at that hard hit category, you've got the likes of GM, so reliant upon these globalized supply chains, but also companies like Chipotle and JetBlue that are more reliant on the consumer feeling comfortable spending on some of these consumer discretionary items. In that can't quantify category, you've got Pfizer, you've got Tesla. These are companies that are based in the United States. They produce a lot of products in the United States, but there's still uncertainty about what the supply chain could do to them. If you think about Tesla, they've got their car business, but also that battery business that relies on batteries from China. That third category, manageable, is a really interesting one. And if you want to focus on one company, focus on Coke. In an earnings report recently, they were able to say, even if they get to a point where there is tariff uncertainty, they can increase prices, even incrementally, on consumers, and they'd be able to withstand that.
So in terms of guidance, Charlie, what else is emerging from corporate earnings today?
Yeah, so it's been a really busy day. We've got a number of big banks reporting. We've got to start with Barclays. Barclays has, beat across the board. They were relatively underperforming, but what they were able to show is that trading revenue boost that a lot of their peers have benefited from recently in choppy markets. And their CEO talking earlier this morning about how volatility could continue to benefit this bank. Talking about banks, we've got Santander. They reported a pretty strong report as well, but the market is not liking what they reported, which was that lending revenue has been ticking down. We do, however, have Executive Chair Anna Botín talking about how the company will be able to continue to return buybacks to investors. That is something that really supported the stock earlier this year, and that's going to be welcome.
Charlie, thank you so much. Charlie Wells there with the very latest on some of the earnings on the roundup for guidance. Now, President Donald Trump's tariffs prompted several of Europe's largest automakers to scrap financial guidance, underlining the extent of Trump's tariff chaos. This morning alone, we have earnings from Volkswagen, Stellantis, and Mercedes. Well, Oliver Crook has been poring over the numbers in Berlin. Ollie, good morning. So let's start with VW. Any good news?
Yeah, Francine, everyone was expecting bad news from the auto sector this quarter and looking into the guidance. So I tried to find a couple highlights here and there, and I think I found a couple of them here for Volkswagen, where they managed to actually get revenue up about 3% in the first quarter. They managed to sell more cars than they did a year ago, which is more than you could say about Stellantis and Mercedes, up about 1 percentage point. And when you look at the regional breakdown, there's some interesting facts within that as well. Europe was up 4%. That's an encouraging sign, a strong market for Volkswagen. South America up 17%. And that just about exhausts the good news that we got out of Volkswagen today. Because when you look at North America and the United States, down 2%, and to China, key market for Volkswagen, of course, down 6%. When you look at their operating profit from a year ago, down about 40%. When you look at their margins are getting consistently eroded, came in at 3.7%. That is 1 percentage point below what the analysts had expected, and that's down from 6% from what it was a year ago. And in terms of guidance, in terms of what Volkswagen can expect, telling investors what they should look for in the rest of the year, they say that their guidance is unchanged, but we're actually not taking into account any of the effects of tariffs, which, as far as I'm concerned, is basically scrapping their guidance, which is something very similar that we've seen from some of the automakers earlier throughout the morning today.
Ollie, what about Stellantis and Mercedes?
Yeah, again, sort of negative outlook when you look there. Overall, you look at the Stellantis number, their revenue was down 14%. They've withdrawn their guidance, saying the same thing as Mercedes-Benz, basically saying that the effects of tariffs are entirely incalculable on the bottom line for these car makers in these sort of coming months. North America for Stellantis, the key market, of course, this is formerly Chrysler, down 20%. Europe, down 8%. Middle East, down 15%. South America, again, bright spot, up 19%. But you get the sort of picture here. For Mercedes-Benz, it's been a very similar outlook. Revenue was down down 7%. When you look at their EBIT, down 40%. And again, this is all going down to this broader picture for the auto sector. They're withdrawing their guidance not just because of the direct impact of tariffs. Of course, this hurts these European car makers that are exporting cars to the United States, but this is a very cyclical industry. So when you have tariffs and when you have a trade war, you have a general slowdown across the globe. That is going to absolutely kill demand for automotive sector, not just in the United States because of tariffs, but globally. And that is what these car makers are ringing the alarm bell this morning. And you heard it very explicitly from Mercedes-Benz. I will give you one last light of ray for the Mercedes-Benz. Though, if you look at their high end, the G-Wagon still doing pretty well, up 18%. The top end of their the range, the most expensive cars, highest margin stuff, still doing pretty well for Mercedes-Benz. But overall, a fairly negative picture.
Ollie, thanks so much. Oliver Crook there with the very latest on the automakers. Now, Bloomberg Balance of Power will be looking back at President Trump's first 100 days in the special program later today. They'll examine the impact of the president's major decisions on markets and the economy. That's at 10 p.m. London time. Up next, Bloomberg Brief with Danny Berger. This is Bloomberg.